Chapter 8, Managerial and Organizational Ethics. People today face ethical issues in a variety of settings, but our concern in this chapter is limited to managerial and organizational ethics. David Callahan's highly influential book titled The Cheating Culture: Why More Americans Are Doing Wrong to Get Ahead talks at length about how these ethical issues touch organizations and managers. Callahan argues that instances of cheating have shot up in today's society and organizations because of four essential reasons. First, higher levels of inequality, which means larger paychecks for some and larger incentives to cut corners to succeed. Secondly, today's widespread insecurities, which can lead ordinary people to think they must cheat to survive. Third, a failure of oversight across many sectors, meaning that cheating often goes unpunished. And four, America's highly individualistic culture, which glorifies wealth, status, and personal gratification. The recent ethics scandals and the global financial crisis are not the only urgent issues facing the corporate world, though they may get the most press coverage. Managers encounter day-to-day ethical challenges in arenas such as conflicts of interest, sexual harassment, inappropriate gifts to corporate personnel, unauthorized payments, customer dealings, evaluation of personnel, and pressure to compromise their personal standards. But often these managers have no experience or training in business ethics or ethical decision-making to tackle such quandaries. Ethics is vital to business success. Ethical issues arise at different levels. As individuals and as managers, we experience ethical pressures or dilemmas in a variety of settings and at different levels of analysis, including the individual or personal level, the managerial and organizational level, the industry level, the societal level, and the global level. First, we all experience personal level ethical challenges. These challenges include situations we face in our personal lives that are generally outside the context of our employment, but they may have implications for our jobs. Examples would be, should I cheat on my income tax return by overinflating my charitable contributions? Should I download music from the internet, although I realize it is someone else's intellectual property? Next, managerial and organizational level. Individuals also encounter ethical issues at the managerial or organizational level, or what is known as the firm level, in their roles as managers or employees. And these include, should I set high performance goals for my work team to benefit the organization, even though I know it may cause them to cut corners to achieve such goals? Should I misrepresent the warranty time on some product I'm selling in order to get the sale? So, unethical practices that may be evident in organizations. To illustrate these types, the results of a revealing survey conducted by the Ethics Resource Center documented the situations that managers and employers often face. And in this survey of employees, the following were some of the types of misconduct observed and reported, along with the percentage of time these items were mentioned. Abusive or intimidating behavior toward employees, there's 23%. Misreporting actual time or hours worked, 20%. Lying to employees, customers, vendors, or the public, 19%. And withholding needed information from employees, customers, vendors, or the public, 18%. Discriminating on the basis of race, color, gender, age, 13%. Stealing, theft, or related fraud, 12%. Each of these categories reveals that the array of questionable practices that employees and managers face every day in their work lives. How they respond to these ethical issues often carry serious consequences for themselves and their organizations. A third level at which a manager or an organization might experience business ethics issue is the industry or professional level. The industry might be stock brokerage, real estate, insurance, financial services, telemarketing. Related to the industry might be the profession of which an individual is a member, say accounting, engineering, medicine, journalism, law. And examples of these dilemmas include, is a standard contract with realtors have adopted really in keeping with the financial disclosure laws that have recently been strengthened? Is it ethical for accountants to allow a restatement of earnings that can cause investors to lose money or confidence in the stock market? At the societal and global levels, it becomes very difficult for the individual manager to have a direct effect on business ethics. However, managers acting in concert through their companies and industries and professional associations can certainly bring about high standards and constructive changes. In discussing managerial ethics, it is anticipated that most individuals want to behave ethically or improve his or her ethical conduct in organizational situations. Managerial ethics, for the most part, entails making decisions which have ethical implications or consequences. Difficult decisions typically present the individual with a conflict of interest situation. A conflict of interest is usually present when the individual has to choose between his or her interest and the interest of someone else or some other group. This could be an organization or stakeholders. And what it boils down to in the final analysis is answering this question: what is the right or fair thing to do in this situation? In answering the question about the right or fair course of action, it often seems that individuals think about the situation briefly and then go with their own instincts. So let's look at the principles approach to ethics. It is based on the idea that employees and managers desire to anchor their decisions and actions on a more solid foundation than that provided with the conventional approach. These principles are normative in nature, as they offer guidance regarding what one ought to do in a situation. From a practical point of view, a principle of business ethics is an ethical concept, a guideline or rule that, if applied when you're faced with an ethical decision or practice, will assist you in taking the ethical course of action. We've often heard of the phrase, honesty is the best policy. This would apply here. Moral philosophers customarily divide ethics principles or theories into two categories: teleological and deontological. The teleological theories focus on the consequences or results of the actions they produce. Utilitarianism is a major principle in this category. It recommends taking action that results in the greatest good for the greatest number. Deontological theories, by contrast, focus on duties. For example, could it be argued that managers have a duty to tell the truth when they are doing business? The principles of rights and of justice, two major ethics theories we will discuss, seem to be non-teleological in character. A third theory is eretic, and it's a lesser known of the category of ethics, and it was put forth by Aristotle. And it means goodness or excellence or virtue. The virtue theory is the best example of an eretic theory. Other principles, such as the principle of caring, the golden rule, and servant leadership, reflect concerns of duty, consequences, and virtue. You can read more about all of the principles of rights, legal rights, the rights that some governing authority, whether it's the Constitution, Bill of Rights, have formalized as rights. Excuse me. An important aspect of the principle of rights is that a right can only be overridden by a more basic or important right. We look at a negative right as the right to be left alone. It is the right to think and act free from the coercion of others. For example, freedom from false imprisonment, illegal search and seizure, and freedom of speech. Those are all forms of negative rights. And a positive right is a right to something, such as a right to food, health care, clean air. In business and in all walks of life, both negative and positive rights are played out in both legally and morally claimed forms. Competing rights. A special problem arises with the right's approach to ethical decision making when the situation is not a clear right versus wrong, but is more nearly a right versus right. So you can read on your own in the textbook the dilemma of competing rights. Next, the principle of justice, or is called also known as the fairness principle. Now, one way to think about the principle of justice is to say that it involves the fair treatment of each person. This is why it is often called the fairness principle. Procedural justice or ethical due process is especially relevant to business and professional organizations. Employees, customers, owners, stakeholders, they all want to be treated fairly. They want to believe that they have been treated rightly and fairly in decision situations. The term process fairness has also been used to describe ethical due process. 3 factors have been identified to help decide whether process fairness has been achieved. First, have people, either employees or customers' input, been included in a decision process? The more this occurs, the more fair the process is perceived to be. Second, do people believe the decisions were made and implemented in an appropriate manner? Consistency is based on accurate information, or at least that's a public expectation. And third, people watch their manager's behavior. Ethical due process or process fairness works effectively with all stakeholders, whether they are employees, customers, owners, or others. Almost everyone responds positively to be treated fairly. Next, the Rawls principles of justice. The political philosopher John Rawls became well known for his own version of ethical due process, and he provided what some have referred to as a comprehensive principle of justice. And the 2 principles of justice that underlie his theory were: 1, each person has an equal right to the most extensive basic liberties compatible with similar liberties for all others. And secondly, social and economic inequalities are arranged so that they are both reasonably expected to be to everyone's advantage and attached to positions and offices open to all. Ethics of care. The concept of ethics of care, or the principles of caring, is being discussed just after our discussion of utilitarianism, rights, and justice, because the alternative view is critical of many traditional views. Some of the traditional views embrace a more masculine approach to perceiving the world and advocate rigid rules with clear lines. The care perspective builds on the work of Carol Gilligan, which we talked about in Chapter 7, who criticized Kohlberg's theory of moral development. And she found that women often spoke in a different voice that was more reflective of responsibility to others and on the continuity of interdependent relationships. Several writers have argued that caring theory is consistent with stakeholder theory, or the stakeholder approach, in that the emphasis is on a more cooperative, caring type of relationship. Virtue ethics emphasizes being. The underlying assumption of virtue ethics is that the actions of a virtuous person will also be virtuous. Virtue ethics focuses on the question, what sort of person should I be or should I become? And programs that have developed from the notion of virtue ethics have sometimes been called character education because this particular approach emphasizes character development. And we look at the universal principles of good character, the 6 pillars as trustworthiness, respect, responsibility, fairness, caring, and citizenship. An increasingly popular approach to organizational leadership and thinking today is servant leadership, and it is an approach to ethical leadership and decision making based on the moral principle of serving others first. Some characteristics really could be stated as virtues, and some could be stated as behaviors. For example, 10 key characteristics essential for the development of servant leaders are listening, empathy, healing, persuasion, stewardship, building community. The Golden Rule merits consideration because of its history and popularity as a basic and strong principle of ethical living and decision making. A number of studies have found it to be the most powerful and useful to managers. The Golden Rule is, do unto others as you would have them do unto you. The key to this, also known as the ethic of reciprocity, is impartiality. That if you want to be treated fairly, treat others fairly. If you want your privacy protected, respect the privacy of others, treat others fairly. It is rooted in tradition and history of religious traditions, and is probably among the oldest of the principles of living. So it's easy to see why Martin Luther said that the Golden Rule is part of the natural law, because it is a moral rule that anyone can recognize and embrace without any particular religious teaching. The Golden Rule is accepted by most people. The Golden Rule is easy to understand. It's a win-win philosophy, and it acts as a compass when you need direction. So this is why managers and decision makers should really adopt the Golden Rule. So in summary, the principles approach to ethics focuses on guidelines or concepts that have been created to help people and organizations make wise ethical decisions. We talked about the two ethical categories that are the ends-based or the teleological, and the deontological, which is more of a duties-based. Both duty and consequences are important ethical concepts. In our discussion, we have treated the following as important concepts of the principles-based approach: utilitarianism, rights, justice, caring, virtue, servant leadership, and the Golden Rule. For the most part, these principles are rooted in moral philosophy, logic, and religion. On a more pragmatic level, we turn now to a series of ethical tests that constitute another approach to ethics. The ethical tests are more practical or hands-on in orientation, and they don't require the depth of moral thinking that principles do. The test of common sense. With the first test, the individual simply asks, does the action I'm getting ready to take really make sense? When you think of behavior that might have ethical implications, it is logical to consider what the practical consequences are. The action would be questionable if it does not pass the test of common sense, or what we call the smell test. If a proposed course of action stinks, don't do it. Test of one's best self. Psychologists tell us that each person has a self-concept. Most people can envision a scenario of themselves at their best. To those concerned about their esteem and reputation, this could be a powerful guide preventing one from taking a questionable course of action. The test of making something public, sometimes called the disclosure rule, is one of the most powerful tests. And if you're about to engage in a questionable practice or action, you might pose the following question: how would I feel if others knew I was doing this? How would I feel if I knew that my decisions or actions were going to be featured on the national or evening news for everybody to see? This test addresses the issue of whether your action or decision can withstand public disclosure and scrutiny. The test of ventilation is to expose your proposed action to others and get their ideas on it before acting. This test works best if you get opinions from people who you know might not see things your way. And the important point here is that you do not isolate yourself with your ethical dilemma, that you would seek others' views. The test of purified idea might be thought of, an idea or action might be thought of to be purified, that is, cleansed or made acceptable, when a person with authority says or implies it is appropriate. One of the most common ethical errors people make, and people must constantly be reminded that they themselves ultimately will be held accountable if an action is indefensible. Another test of your ethical behavior is to question whether it has fallen victim to the Big Four. The Big Four are 4 characteristics of decision making that may lead you astray or toward the unethical course of action. The 4 factors are greed, speed, laziness, and haziness. Greed is a drive to acquire more and more in your own self-interest. Speed is a tendency to rush things and cut corners because you're under pressure of time. But don't confuse cutting corners with efficiency. Laziness may lead you to take the easiest course of action that requires the least amount of effort, and this can really lead to mental errors. And haziness may lead you to acting or reacting without a clear idea of what is going on. So all 4 of these factors represent temptations that, if you succumb to them, might lead to unethical behavior. The gag test was provided by a judge on the Louisiana Court of Appeals, and he argued that a manager's clearest signal that a dubious decision or action is going too far is when you simply gag at the prospect of carrying it out. His test is intended to be more humorous than serious, but a few might be helped by it. So our discussion is centered on principles, guidelines, and approaches to managerial decision making. Ethical decision making is at the heart of business ethics, and you can't stress enough the need to sharpen decision making skills if amorality is to be prevented and moral management is to be achieved. You have to sharpen those skills and must see the organization's ethical climate as part of its corporate culture. An ethical climate is shaped through actions taken, policies established, and examples that are set. In this chart, and in figure 8.3 in your book, portrays several levels of moral climate and some of the key factors that may have come to bear on the manager as he or she makes decisions. What happens within organizations, as this slide depicts, is nestled in industries, businesses, and society's moral climate. So the focus of this section is on the organization's moral climate. Regardless of ethical individuals, organizational factors prove to be powerful in shaping ethical or unethical behavior and practices. The following 3 major questions drive the consideration of organizational ethics. What factors contribute to ethical and unethical behavior in an organization? What actions, strategies, or best practices might the management use to improve organizational's ethical climate? And last, what psychological and organizational processes revealed through behavioral ethics come into play when ethical decision making and behavior are pursued? For managers to be able to create an ethical work climate, they must first understand the factors at work in the organization that influence whether or not other managers and employees behave ethically. And several studies have been conducted, and they've sought to identify and rank the sources of ethical behavior in organizations. behavior of superiors was ranked as the primary influence on unethical behavior in 3 studies. In other words, the influence of bosses is powerful. Behavior of one's peers was ranked high in 2 of 3 studies. People do pay attention to what their peers are doing and expecting. Industry or professional ethical practices, ranked in the upper half in all 3 studies, and these contextual factors are influential. Personal financial need ranked last in all 3 studies, but you can't assume it does not matter, because for some people it does. Because the behavior of managers has been identified as the most important influence on the ethical behavior of organization members, it should come as no surprise then that most actions and strategies for improving the organization's ethical culture must originate from top management and from other management levels as well. Organizational ethical culture refers to shared values, beliefs, behaviors, and way of doing things in the organization. Another factor important to an ethical culture is whether the organization has a compliance or an ethics orientation. An organization with a culture of ethics is most likely a mixture of an emphasis on compliance and on such values as integrity or ethics. Several concerns about compliance focus have been identified. First, a pure compliance focus could undermine the ways of thinking or habits of mind that are needed in ethics thinking. Ethics thinking is more principles-based, while compliance thinking is more rules-based. Secondly, it has been argued that compliance can squeeze out ethics. An organization can become so focused on following the law that ethics considerations no longer get factored into discussions. And third, the issue of false consciousness has been raised. And this means that managers may become accustomed to addressing issues in a rules-based way, and this may cause them to not consider tougher issues that a more ethics-focused approach might acquire. Best practices are those approaches, programs, policy, or guidelines that experience has shown produce the most effective results. Oversight has become especially vital in recent years as corporate governance has discovered to be an integral part of an ethical culture. There are 3 key elements that must exist if an ethical organizational culture is to be developed and sustained. 1, the continuous presence of ethical leadership reflected by a board of directors, senior executives, and managers. The existence of a set of core ethical values infused throughout the organization by ways of policies, processes, and practices. And lastly, the formal ethics program that includes a code of ethics, ethics training, ethics officers, and ethical training. It has become an established principle of ethical leadership that the moral tone of an organization is set by top management. One poll of communication professionals found that over half believe that top management is an organization's consciousness. This is because managers and employees look to their bosses for cues regarding acceptable practices and policies. Leaders set the tone of an organization by enacting practices, policies, procedures that help facilitate the display of ethical behavior and really reduce the likelihood of misconduct. So top management, through its capacity to set a personal example and to shape policy, is in the ideal position to provide a highly visible role model. So we'll look at weak moral management. We'll look at weak ethical leadership. An example of this, or role modeling or weak ethical leadership, was found in one of the author's consulting experiences in a small company where a longtime employee was identified as having embezzled about $20,000 over a 15-year period. And when the employee was questioned as to why she had done this, she explained that she thought it was all right because the president of the company had led her to believe it was okay by his actions. She explained that any time during the fall when the leaves had fallen in his yard and he needed them raked, he would simply take the company personnel off their jobs and have them do it. When he needed cash, he would take it out of the company's petty cash box or get the key to the soft drink machine and raid the coin box. When he needed stamps to mail his personal Christmas cards, he would take them out of the company's stamp box. So the woman's perception was that it was okay for her to take the money because the president did it frequently. And so she thought it was an acceptable practice for her. When later questioned, the president admitted that this was all true, and he thought the woman should not be dealt with too harshly. Strong ethical leadership, an example of this is seen in the case of a firm that was a manufacturing firm that made modern vacuum tubes. One day the plant manager called a meeting and to announce that a sample of tubes in production had failed a critical safety test. And this meant that the safety and performance of the batch of 10,000 tubes was highly questionable. And so he thought out loud, what are we going to do? And ethical leadership was shown by the vice president for technical operations. He looked around the room at each person and then he said, scrap them. And according to an employee who worked for the vice president, that act was set the tone for the corporation for years because every person present knew of a situation in which faulty products had been shipped under pressure of time and budget. Two pillars of leadership. It's been argued that a manager's reputation for ethical leadership is founded on two pillars. Perceptions of the manager both as a moral person and as a moral manager. Being a moral person requires three major attributes: traits, behaviors, and decision making. Important traits are stable personal attributes such as integrity, honesty, and trustworthiness. Critical behaviors, what you do, not what you say, include doing the right thing. So the idea of the second pillar, being a moral manager, was developed and discussed in one of our previous chapters. And moral managers recognize the importance of proactively putting ethics at the forefront of their ethical agenda. Good leadership necessarily consists of a moral judgment, and putting ethics at the forefront involves three major activities. First, the moral manager must engage in role modeling through visible action. The moral manager communicates about ethics and values. And third, the moral manager needs to use rewards and discipline effectively. And this is a powerful way to send signals about desirable and undesirable conduct in the workplace. So management also carries a burden in terms of providing ethical leadership in the area of effective communication. And we've seen the importance of communicating through acts, principles, and organizational climate. But if an organization's members don't clearly understand what these ethical standards or values or expectations are, it creates an impediment to their use. So conveying the importance of ethics through communication includes both written and verbal forms of communication. It also includes nonverbal communications. Management should operate according to key ethical principles. Candor, fidelity, confidentiality are three important communication principles. Candor requires a manager to be forthright, sincere, and honest in communication transaction. It requires the manager to be fair and free from prejudice and malice in communication. Fidelity means the communicator should be faithful to detail, be accurate, and avoid deception or exaggeration. And lastly, confidentiality is another principle that ought to be stressed, and the ethical manager must exercise care in deciding what information he or she discloses to others. Trust can be easily shattered if the manager doesn't have a keen sense of what is confidential in a communication. One of the most important strategies in creating an ethical workplace culture is the use of ethics and compliance programs, along with officers to lead them in their initiatives and responsibilities. And ethics and compliance programs are typically organizational units, people or departments that have been assigned the responsibility of monitoring and improving ethics in an organization. And we won't spend a lot of time on this area. Ethics and compliance officers, compliance programs will focus on structure, oversight, due diligence, communication, monitoring. Compliance officers head up these compliance programs. They implement a variety of ethical and compliance initiatives. Many of these were hired after this Sarbanes-Oxley Act that we had spoken about previously, and started with compliance issues, and ethics became the focal point later on. So closely related to all ethics initiatives and programs being implemented by top management is the necessity that managers at all levels would set realistic goals and expectations. Managers must be sensitive to the possibility of unintentionally creating situations in which others may perceive as a need to cut corners or do the wrong thing. And unrealistic expectations are the primary driver of employees perceiving excessive pressure to achieve goals. So managers need to be really keenly sensitive to the possibility of unintentionally creating situations in which others may perceive a need or incentive to cut corners. The kind of knowledge is what justifies business ethics being a management and leadership topic. So decision making is at the heart of the management process. And if there's any practice or process that is synonymous with management, it is decision making. And it entails a process of stating the problem, analyzing the problem, identifying possible courses of action that might be taken, evaluating these courses of action, deciding on the best alternative, and then implementing that whatever chosen course of action there is. So it's not simply a process, but rather it's multifaceted and is complicated by multiple alternatives and mixed outcomes, uncertain and extended consequences, and personal implications. So this figure presents one conception of the ethical decision-making process. And in this model, the manager is asked to identify the action, decision, or behavior that is being considered and then work through the steps in the model. In the ethics screen presented in this model, we reference our earlier discussion of the conventional approach, that embodying societal and standard norms, the principles approach, and the ethical test approach to decision making. And by using all or a combination of these ethical standards, it is expected that more ethical decisions will be made than would have been made otherwise. Another useful approach to making ethical decisions is to systematically ask and answer a series of simple questions. And this approach is similar to the ethics test approach. And it's just answering the quick questions. Is the action, it's just a brief set of questions to make ethical decisions. And is it legal? Does it comply with our values? If you do it, will you feel bad? How will it look in the newspaper? If you know it's wrong, don't do it. If you're not sure, ask, and keep asking until you get an answer. A code of ethics or conduct. Top management has the responsibility for establishing standards of behavior and effectively, communicating those standards to all managers and employees in an organization. And the most formal way by which companies and ethics officers have fulfilled this responsibility is through the use of a code of ethics or a code of conduct. A code of conduct is often the single most important element of your ethics and compliance program because it really sets the tone and direction for the entire function. And the code is often a standalone document, usually just a few pages in length, and it introduces the concept of ethics and compliance, and it provides an overview of what you mean when you talk about ethical business conduct. So the content of these codes of conduct basically are employment practices, employee, client, vendor information, public information communications, conflict of interest, relationships with vendors, also involves environmental issues, ethical management practices, and political involvement as well. One problem that frequently leads to covering up of unethical acts by people in an organization is that they don't know how to respond when they witness or suspect a questionable behavior. And an effective ethical culture is contingent upon employees having a mechanism and top management being supportive of reporting violations or blowing the whistle. Sometimes this is done by hotlines. They're the most common way to report corporate fraud. And this can be telephone, web, or it can be email based. Business ethics training today and training programs are really considered to be one of the most important best practices in organizational ethics. And what are the goals of ethics training? And different companies set different goals, but a typical set of goals for ethics training include the following listed here: fundamentals of business ethics, to solve ethical dilemmas, to learn to identify causes of unethical behavior, to learn about common managerial issues, to learn whistleblowing criteria and risk, and also to learn to develop a code of ethics and execute an internal ethics. And next we'll look at what are ethics audits and risk management. In increasing numbers, companies today are beginning to appreciate the need to follow up on their ethics initiatives, and audits are intended to carefully review ethics initiatives such as ethics programs, code of conducts, hotlines, and ethics training to determine their effectiveness and the results. And this might include management sincerity, communication efforts, incentive and rewards program, and other activities. A sustainability audit is another popular variation on the ethics audit, and more companies are employing this approach for identifying and managing sustainability issues within their organizations. They really want to improve the credibility of their sustainability reports and provide confidence to all stakeholders. And spurred on by the revised federal sentencing guidelines and really more recent legislations, companies are designing and conducting fraud risk assessments, and this is a review process designed to identify and monitor conditions and events that may have some bearing on the company's exposure to compliance misconduct risk, and to review companies' methods for dealing with these type of concerns. And according to recent surveys, The top 5 subjects of ethics programs risk analysis are internal policies and processes, employee awareness and understanding of compliance and ethic issues, anonymous reporting systems, disciplinary systems and prevention tools, and employee intent. One of the most important practices in the improvement of ethics programs and ethical conduct of an organization is that of transparency. Corporate transparency refers to a quality, characteristic, or state in which activities, processes, practices, and decisions that take place in companies become open or visible to the outside world. A common definition of transparency is the degree to which an organization provides public access to information, accepts responsibility for its actions, makes decisions more openly, establishes incentives for leaders to uphold these standards. Board of directors and oversight. You might think that oversight and leadership of ethics initiatives by the board of directors or businesses would just be a given. But leadership in this has really not been the case in leadership and in many instances. And so the primary impetus for board involvement and oversight has been so many of the mega scandals that have taken place over the past couple of decades. And then this is it's impacted, many major companies, and it's been coupled with the passage of the Sarbanes-Oxley Act, which we've talked about, and it overhauled federal securities laws to improve corporate governance, and really emphasizing the board's role in oversight of corporate ethics as one of the most urgent issues in recent years. Strong leadership from the board and CEOs is still the most powerful force in improving a company's ethical culture. So far, we've talked about managerial ethics and challenges involved in managing organizational ethics. So now it's helpful to focus on what is a relatively new field of thought, and it has been termed behavioral ethics. And for the most part, our discussions to this point have been normative in nature. And behavioral ethics, by contrast, helps us to understand a deeper level, at a deeper level, many of the behavioral processes that research has shown actually are taking place in people and organizations. And most of the learnings are descriptive in nature as they strive to capture insights into the processes that have been observed by taking place in actual practice. So we'll look at some of the phenomena that has been observed that would fit into the category of behavioral ethics are worthy of noting briefly. Bounded ethicality tends to occur when managers and employers find that even when they aspire to behave ethically, it is difficult due to a variety of organizational pressures and psychological tendencies to intervene. There are limits to people's abilities to be ethical. Tendencies toward bounded ethicality might include claiming credit for a group's work, maybe without realizing you were doing it, engaging in implicit discrimination and in-group favoritism, and falling prey to the influence of conflicts of interest. Conformity bias is a behavioral pattern that has also been observed. This is a tendency people have to take their cues for ethical behavior from their peers rather than exercising their own independent ethical judgment. And overcoming overconfidence bias. People may be more confident of their moral character than they have reason to be. So the conformity bias, as we talked about, is a behavioral pattern that is often observed, and it's like I said, the tendency to take cues from other people. Self-serving bias is similar, and this is a propensity, or similar to overconfidence bias, propensity to have process information in a way that serves to support their pre-existing beliefs and their own perceived self-interest. Framing refers to the fact that people's ethical judgments are affected by how a question or issue is posed or framed. It's been found that, for example, people prompted to think of an issue as an ethical issue, they will tend to make more ethical decisions than if they have been prompted to think of it as a business issue. Incrementalism is a predisposition toward the slippery slope. It's been noted that there is a tendency toward making a series of minor ethical misjudgments that can really lead to major ethical mistakes. Role morality is the tendency for some people to have to use different ethical standards as they move through different roles in life. For example, a person might make more questionable decisions at work when job and profits are at stake than they would at home or in their family. And finally, moral equilibrium has been observed, and this is a penchant for people to keep an ethical scoreboard in their heads and use this information when making future decisions. There are 5 barriers to an ethical organization, and they include ill-conceived goals. These are poorly set goals that encourage negative behaviors such as sales goals, emphasize too much or too high. Motivated blindness, it's the process of overlooking the questionable actions of others when it is in one's own best interest. This is the self-serving bias described earlier. Indirect blindness occurs when one holds others less accountable for unethical behaviors when they are carried out through third parties. The slippery slope we mentioned earlier as incrementalism, and it causes people to not notice others' unethical behavior when it gradually occurs in very small increments. And finally, overcoming values is the act of letting questionable behaviors pass if the outcome is good. And this can occur when managers overemphasize results rather than how the results are achieved. And it could be played out as the ends justifying the means. So we discussed ethical or moral acts, decisions, practices, managers, and organizations. And though the goal of ethics initiatives is to develop moral organizations, sometimes all we get are isolated ethical acts, decisions, or practices, or if we're fortunate, a few moral managers. So finally, the highest goal for managers may be to create moral organizations, for which many of the best practices discussed in this chapter will need to be successfully implemented. And as the ethicist Kenneth Goodpaster reminded us, the depths of a company's culture, commitment to ethical values, and the pursuit of economic values are a mark of corporate moral development. So the important point here is to emphasize that the goal of managers should be to create moral decisions, moral managers, and ultimately moral organizations, while recognizing that we are frequently observed in business as the achievement of moral standing at only one of these levels. So the idea is to create moral organization that is fully populated by moral managers making moral decisions, and these are practices, policies, behavior, and this unfortunately is seldom achieved. So to wrap things up, this figure 8.8 depicts the sequencing of goals of each of these levels. And once moral organizations are achieved, the stories and successes feed back in such a way that they augment the creation of moral managers and moral decisions. And over time, the overall level of moral development and maturity should rise when this process is repeated over several cycles. So these challenges become even more specialized when we consider business ethics and technology in future chapters that we'll go over, and ethical issues in the global arena. And that wraps up Chapter 8.